We also, of course, had GDP today. The economy growing in the third quarter at the fastest rate since late 2021. And that move defying continued predictions for a slowdown. Many expected the Fed's policy tightening to start to constrain consumer spending. However, our next guest says the move in Treasury yields is pointing to the likelihood of a recession on the horizon. That's Tony Dwyer. He's joining us right now, Canaccord Genuity Chief Market Strategist and head of the U.S. Macro Group. Tony, it is fantastic to see you as always. You just heard Josh and I talking about we've got higher rates. Companies are sort of talking about it in the background. It didn't seem to really crimp GDP. So what's going to change here?
Well, CEOs aren't worried about it until they actually have to raise money. Look at what happened with the Treasury new issuance. I think a lot of people are looking at maybe the Treasury market has been a statement about inflation, but inflation break-evens didn't really move that much. It came down to, if you pinpoint the peak day for the S&P 500, it was July 31st. And when yields started really rising more aggressively, it was July 31st when Janet Yellen announced a third more Treasury new issuance. And I know this has become a theme a lot of people are talking about, but we had talked about it at that point. You have lost your three biggest buyers. Your Fed is doing quantitative tightening. China and Japan are protecting their own currency, and banks are under regulatory scrutiny for capital. So when you're in that situation, you get outsized moves. And our theme our written note earlier this week, higher for shorter, is a reflection of that.
And Tony, we've had plenty of smart economists and strategists on the show, and they are in this, the soft landing camp here, Tony. So recession coming back to 2% without an economic downturn. But Tony, you are not in that camp, correct? You think we are due for a recession here?
I'll give you the strategist hedge. There's really no chance that, in my view, I don't know how we avoid a recession. Our view coming in this year, Josh, throughout the year was that a soft landing scenario is the worst case scenario, because it creates that perception of higher for longer interest rates, which keeps them rising. Interest rates on the intermediate long end of the curve are up 25% from where they were in the beginning of September. So when you actually look at it's not like interest rates have just sat there. So when they move like that, it reinforces the idea that you're not going to have a soft landing because the conditions have changed. Now, earlier we were talking about CEOs aren't really responding to it yet because they haven't had to raise new money at the higher rates. When Janet Yellen announced that she was going to raise $1 trillion in Q3, that was at 5%. That's not at 0.5% or 1% where they had raised it in the past. So when you have to reissue or issue debt, that's when it becomes a bigger problem for a CEO.
Right, that does make sense. So when we're talking about higher for shorter, the thesis being that we go into a recession and then the Fed has to cut, right?
Yep, like they do. Julie, even in a soft landing scenario, if you look at 1966 or 1995, you had at least a 200 basis point move and long duration Treasury yields. So you really need a huge move coming out of the Treasuries, but also the mortgages and corporates. And that has to come from a major tone change in the Fed. And that tone change in the Fed that makes them cut rates is typically some kind of event and or dramatically weaker economic data. As an example, 1995, the mystical soft landing that everybody wants to have here, which I would love to have, frankly, too. I'd love to be wrong, is that the Orange County bankruptcy in 1994 is what drove the Fed to change their tone aggressively. The last rate hike was February of 95, but you had already seen a significant drop in Treasury mortgage and corporate rates. By that time, they raised the last time. We haven't seen that yet. We're making, or not today, but earlier this week, we made new cycle high for bond yields. So that to me is the real differentiator, is what gets the Fed to change their tone enough that you get those other instruments to have a significant rally that kickstarts an improved outlook for money.
So Tony, what's the answer to that question? And I can, obviously we don't know for sure, but what's the Orange County bankruptcy of 2023?
Some were thinking it might have been Silicon Valley Bank, but that was more of a one-off. To me, it typically comes in a place that nobody can see that's unregulated. And the biggest growth in the unregulated finance market is private equity, private credit. So I don't know. I wish I had insight into what's going to cause it, and I would be arrogant. We're all, it's funny you say that you had a lot of smart strategists and economists, and I don't know. You better go find one because you're in the wrong place here. But, to me, you can't figure it, by definition, it would be discounted if you knew what it could be. It's something that typically, like long-term capital in 1998, we knew that rates were going up and mortgages were becoming an issue, but nobody saw the long-term capital situation happening. Just like in 1994, nobody saw Orange County declaring bankruptcy. I don't know what it is, but in my opinion, we're getting closer to it, which is beginning to get reflected in a little bit lower yields. And as that accelerates, that could help us create at least a temporary bottom for stocks.
Yeah, I'm interested, Tony. So just given your view of the economy, that we're headed for a recession, what's an investor to do, though? What's the response to that? Is it, all right, I hear that, I buy Tony's argument, I'm fleeing stocks? Is that the move? Even as we know, Tony, a lot of names have been pretty banged up.
Yeah, exactly, Josh. So we've been called what's light and tight, meaning light in exposure, so have a little extra cash, and slightly defensive. I think the defensive areas like Utes, consumer staples, and healthcare work because they've been so decimated, and they've also been subject to those higher yields. They've been hit not just because of fundamentals, but those higher interest rates. If I'm right, and interest rates come off on weaker economic data, you're going to get those areas to lift. And we saw that yesterday. Even though you got a big hit in the market on an interest rate spike, utilities and staples outperformed. So I think if you have to be invested, I think it's not defensive because the end of the world is coming. For a lot of stocks like financials, it's already happened. I mean, the Russell 2000 is down 33%. So somebody's got to tell me it's been a great year for stocks, from peak I'm talking about. So when we're looking at it, Josh, it really is, if you are invested, it's to be in those areas that benefit from the lower interest rate environment that most people have given up on.
Yeah, it's interesting you mentioned small caps. Someone in one of our Slack channels just shared a chart of the total market cap of the Russell 2000 versus Apple's market cap, and Apple's is bigger.
Yeah.
And does, what does that kind of tell you about an inflection point? And also, what does it tell you about what you want to do with tech right now?
Well, you're getting close. You're getting to the closer. We're 2 years into this, Julie. It's not the beginning of the bear market. We're 2 years into it, especially if you're in the small cap world, and especially if you're in the even the QQQs. Let's take those, the top 10 stocks, the mega cap ones that everybody really loved, and it had a huge year. They're still well below peak. They were bouncing back from an enormous decline into the end of last year. So our view is while you're how do you know when you get closer to the end of a decline, like a longer duration decline? They shoot the winners. And now you're seeing some of that in the mega cap stocks that are under a little bit of pressure that even had good earnings, but they're still down, and they're down without interest rates going up. So the last leg of a decline is typically you shoot the winners and bad news becomes bad news. It's when the economic news and the outlook for earnings is more important than the outlook for interest rates. And I think we're in the beginning of that discovery process now. So I really want to be clear. I really want to be clear, guys. Like, now is not the time. Last year, when they're beginning to jump rates 75 basis point at a clip, to me, that was the time to be, bearish, really bearish. Now the market can go down, but I want to take advantage of it because we are longer into this cycle, especially if lower interest rates, if interest rates come down.
Tony Dwyer, thank you so much for your time and your insight to Tony. That was great.
Happy to be with you. Thanks for having me, guys.